Breaking. Oil prices are at 7-month highs and climbing as U.S.-Iran tensions collide with European energy policy and a war that is already reshaping global markets. Tonight we are covering 4 angles of this story, from diplomatic uncertainty to Russia's windfall profits. Stay with us. Here is what multiple sources agree on. Oil prices have surged to 7-month highs amid escalating tensions between the United States and Iran, centered on Tehran's nuclear program. According to Reuters, Al Jazeera, and The Guardian, both sides have engaged in military posturing while diplomatic talks remain uncertain. A U.S.-Israeli military conflict with Iran has been underway for approximately 4 weeks, according to multiple wire reports. That conflict has driven a significant spike in global oil prices, which in turn has rippled outward, raising consumer costs in the United States, boosting Russian oil revenues, and putting pressure on European energy policy. The full economic and geopolitical consequences are still unfolding. The first angle is the diplomatic picture, and it is far from clear. Al Jazeera reports that oil prices surged amid mixed and conflicting signals surrounding U.S.-Iran peace talks, with markets reacting to the ambiguity of the process itself. The Guardian frames it differently. Left-leaning outlets lead with traitor fears of outright military conflict, with analysts quoted describing the price movement as markets pricing in a worst-case scenario. So, who is driving the market? Is it uncertainty about diplomacy or fear of war? Al Jazeera emphasizes the former. The Guardian emphasizes the latter. The agreed fact: oil prices reached 7-month highs according to both outlets. That framing gap matters because it shapes how viewers understand whether diplomacy is working or failing. The second angle is about who benefits, and the answer may surprise some viewers. Conservative-leaning outlets, citing the U.S. Bureau of Labor Statistics, focus on the domestic cost. The Consumer Price Index rose 0.9% in March, pushing annual inflation to 3.3%, with energy costs up 10.9%. A direct consequence of the conflict, according to the Daily Caller. Wire reports take a wider view. According to the Center for Research on Energy and Clean Air, known as CAREA, Russia's average daily oil export earnings reached an estimated 388 million euros per day, roughly 20% above its February average, as rising oil prices partially offset the economic pressure that Western sanctions were designed to create. Conservative coverage frames this as an inflation story for American families. Left-leaning and wire coverage frames it as a geopolitical miscalculation. The hardest fact belongs to both sides. The same price spike is hurting U.S. consumers and helping Moscow simultaneously. The third angle moves to Europe, where energy policy is under serious strain. According to the Financial Times, as cited by wire sources, the European Union has declined to reverse its ban on Russian liquefied natural gas imports, commonly known as LNG, despite rising concerns about supply adequacy heading into winter. Wire sources covering the conservative framing angle note that demand for services has reached a 3-year high even as energy costs climb, foregrounding the burden on consumers and businesses. Left-leaning wire reports center the EU's decision itself as the defining development, framing it as a deliberate policy choice with significant supply-side consequences. The tension, both sides acknowledge, is real. The EU is holding a sanctions line while energy costs rise. What remains unresolved is whether that position is sustainable if supply shortfalls materialize this winter. The fourth angle is the military and rhetorical escalation, and how different outlets are weighing it. Reuters reports oil prices rose in what it describes as choppy trading, a term that signals volatility without a clear directional trend as U.S.-Iran rhetoric intensified. News Neutral leads with the market reaction as the primary story, rising oil prices as the economic signal of geopolitical risk. The Guardian takes a different approach, leading with fears of potential U.S. military strikes on Iran, and using a live blog format to convey the ongoing and escalating nature of the standoff over Tehran's nuclear program. According to both Reuters and The Guardian, military posturing by both sides was underway during this period. The framing gap here is significant. One side sees an oil story with a geopolitical backdrop, the other sees a security crisis with an oil price consequence. Step back and look at all four angles together, and a larger picture emerges. A single conflict, the U.S.-Iran standoff over Tehran's nuclear program, is simultaneously driving oil market volatility, raising inflation for American consumers, boosting Russian war revenues, and testing the limits of European energy policy. These are not separate stories. They are connected consequences of the same underlying tension. The biggest unresolved question is whether U.S.-Iran diplomacy produces a durable agreement or collapses into wider conflict. If talks fail, every one of these pressures intensifies. If they succeed, markets could reverse sharply. Viewers should watch the next round of diplomatic signals closely and watch whether the EU's energy position holds as winter approaches. So here is the question we are leaving you with tonight. If a single regional conflict can simultaneously spike inflation in the United States, fund Russia's war in Ukraine, and strain European energy security, what does that tell us about how interconnected and fragile the global energy system really is? That is SkunkFeed, keeping you informed, not influenced. Like and follow for updates as this story develops.